All right. All right, so we will get started. And I see go off in a weird space because I'm letting people in at the same time. All right, so thanks you guys for jumping on. I think this is a really fun topic. So don't be alarmed, it's going to be a little numbers driven, but I think it would be really good for you guys to just see some examples of things and just then I can answer questions on stuff as well. So I'm going to share my screen with all of you and we'll get a move on. Right there. Okay, so everyone can see my screen? Yay. Okay, perfect. All right, so appraisal gaps and cash offers, the real numbers behind some of this stuff. So this appraisal gap thing comes up a lot, and I feel like when I wanted to get down to understanding how do you guys interpret appraisal gap, I called like 3 different agents, and all of them I think do really, really good business. All 3 of them gave me different definitions or ways that they interpret appraisal gap or write appraisal gap, etc. So it just kind of caused me to think, ooh, we've got to talk through this and you know, at least have people understand from our side of the world. And then if you interpret it different or write it different, up to you guys. All right, so appraisal gap, cash offers, the money behind. So in here, I also included some things about closing costs because I think it's always important for you guys to kind of understand what's normal and what isn't. So I'll go through this section kind of fast because it always drives me crazy when clients say to us, oh, we went over here because the closing costs were a little bit cheaper. Okay, well, because you lowballed the title fees or the escrows, that doesn't mean my title fees were, or my closing fees were less. So clients don't know how to look at this. So I always try to explain it to you guys. I explain it to them. And then if they have questions, then at least you understand it too. So normal third-party fees. These are third-party fees. What I mean by that is they are done by somebody else. The title company, doesn't matter who you work with, whatever their fees are, they are. I always use a title company that is a little bit more expensive because I do not want a client to go, oh, I'm using this title company and I lowballed or used a title company that was cheaper and now their fees are higher. Like I hate that. So I will always show higher fees and I tell them, hey, once you go under contract, I guarantee all of them include third party. So title company fees, recording fees, mortgage registration tax, they are all third-party fees. Doesn't matter who you work with, they will be the same. These fees, appraisal, that is literally an invoice. Credit report, literally an invoice. Flood certification, literally an invoice that we can give to the client and show exactly what those fees are. Lender fees, this is lender fees. Underwriting fee, commitment fee, doc prep fee, all of those are kind of lender fees or junk fees, okay? That's what the lender makes or tries to collect so that our underwriting team is covered or our processing team, et cetera. So this is an area that sometimes people get confused on because there's lots of little things in there and they're always called different things. So lender fee, doc prep, underwriting, always called something. These fees in general are going to range from about $650 to $1,500. That's the range. Prepaid expenses. These are setting up taxes and insurance to be paid on their behalf. First year of homeowners insurance is always in there. The other thing that always catches me is mortgage insurance. If we're doing a single pay mortgage insurance, it will show up in the prepaids. So I had a client tell me that she thought our fees were more expensive because she was doing a single pay mortgage insurance and it was showing up there. We weren't, we were actually cheaper, but it's how they interpret. You know, they're not getting these breakdowns, they're just getting the totals. Lastly, points and origination. Points and origination fees go hand in hand. They buy the interest rate down, okay? So again, my world, I feel like people professionally try to confuse the consumer. So they will say, oh, there's no points, yet there'll be an origination fee. It's the same thing. If you are buying the interest rate down, this is where it's going to show up, discount or origination fees, okay? So just so you guys know, I did a little experiment. So at between 9 and 9:15, I went to Rocket Mortgage, I went to Wells Fargo, and I went to US Bank. I requested that I get a 5% down first-time buyer loan, meaning home ready or their income limits are a certain level. So this is what I got from Rocket Mortgage. Okay, look at this. I wanted 5% down. What did they give me? 79.5% down. And guess what else they did? Charged a bunch of points. Okay, but they gave me 4.5. I went to US Bank. Look at this. Those guys gave me 4.8. APR, I have no idea if they're charging any points because they didn't do a breakdown, but I'm assuming in that there's probably at least a quarter to a half. Okay. They also said you have to have a 740 FICO. This is my friend Wells Fargo, 30-year fixed, 4.5. Okay. Now, interesting, they don't tell me anything here. I have to go to the fine print, and then they say credit score of 740 includes 5/8 of a point discount point. So again, origination, discount, same thing. Also assumes, guess what? 25% down. That's not what I asked for. But this is what's happening when your clients are looking online. What they stop at is this, and they go, oh, that rate's better. But they don't see all this extra stuff or what is required for down payment or credit score requirements, et cetera. Look at this, closing costs, including required discount points. Like, this is where, when I'm talking to clients, I spend a lot of time explaining. And so sometimes if you ever get a client that says, oh, their fees were too much or whatever, sometimes kick them back to us or review what they're looking at, because they are being professionally confused in lots of ways. I look at that stuff, I put in 5% down, I get 3 different options, 3 totally different options than what I requested. It's crazy. All right, and I do this every single day. You guys do this every single day, but they don't. So again, I'm not going to spend a lot of time on this because I just thought this was something like a good reference. For conventional loans, these are obviously 647, 200 loan amounts or less. This is what, we can utilize. So there's some down payment assistance. Incomes vary, if you are going to do that. Otherwise, 3% down is normal, or 5% down is also normal if they are not a first-time buyer or they exceed income limits. Jumbo stuff, that's kind of how that plays out with regards to down payment. Everyone too, I will send over this PDF or this PowerPoint to you guys so you have these just for reference. VA 0, USDA 0, FHA 3.5. We also have physician loans, 0 down up to 750, 5% down up to $1 million, 10% down over $1 million. Those are no MI loans. So those are huge. Okay, now let's get into this. These are questions I get all the time. And what are some things that we do to kind of help clients understand when they have to offer more in this market? So we have something called bid over ask. It works 70 to 80% of the time. And this is something where I would punch in the original sale price, what the seller bought it for, and it would kind of calculate out what they were offering, how much that property is appreciated since they bought it, and when is that break even, the break even of what they're asking for purchase price versus what they're willing to pay. So 26 months. So when I'm talking to clients, I'll show them like, hey, if you're going to be in a house for at least 3 to 4 years, absolutely you should feel comfortable paying over by X. And we kind of do this with this breakout. And if you guys ever want me to do this, let me know. Like I said, it works about 80% of the time. Where it doesn't work is if someone's done a bunch of work or they've done a bunch of improvements, because it can't calculate that. This is the one I probably use the most, where I will talk to a client and say, okay, if you're going to buy in Ramsey County, or, I'll punch in the zip code, I will say, if you are willing to go over 10%, you'll make that up, it looks like, in about 2 years. So you're just biting into appreciation for about 2 years, and then everything beyond that will be good based on the data that we're seeing here. So again, these are some of the tools that we're using with clients. And if you guys ever want these or want me to do it on a client, let me know. Again, Hennepin County, you see how it's a little bit different. It's a little bit higher on the estimates. And again, I would punch it in by either the property or the zip code. Okay. All right, so let's get into appraisal gap, because I think this is something that one can be really confusing for a listing agent when they are reviewing offers, but also really confusing for your clients. And this is something that on the first go around, when I do my pre-approval appointment with them, I don't spend a ton of time here, because like this, it's like an infinite number of options and number options, and they're already being spoon-fed a ton of stuff. So I tell them, your agent will bring up appraisal gap. If that comes up, let's talk about it when you're ready to do it. Because, and I will show you down the road, if they are doing 20% down, you guys should not even worry about an appraisal gap. You should waive it. And I'll show you numbers as to explain why. So this is why it matters. It's purchase price or appraised value. Whatever is less is where our financing starts. So you can see right here, if we've got a 300K appraisal and a 300K purchase, 5% down, I can lend a loan 285. But if I've got a 280 appraisal and a 300 purchase price, the max loan I can do is 266. Okay, so that's where that gap comes in. So here is an example. Okay, here is an example of a purchase price. So right here would be a normal loan. Purchase price of 330, 10% down, appraised value of 330, base loan amount, 10% down, P&I, MI. So right now on some of these, it just depends what they're doing. I am recommending a lot of monthly MI, which I would never, ever, ever do before, because I hate monthly MI. But the reason I'm doing it now is because I fully believe we'll be in a recession in the next 12 to 24 months. And I don't think a lot of money should be paid up front with regards to points or regards to mortgage insurance up front, because you typically would buy down a mortgage if you're going to be there a really long time, and you would typically pay mortgage insurance in a single premium so that you didn't have to worry about it down the road. But if we truly think we're probably going to be refinancing a lot of these folks in the next year, 2.5 years, their fees that will be for the single pay MI or any points typically will not be utilized. They will have wasted that money. So that's why I'm kind of showing the monthly right now. So this is normal. Purchase price at 330, 10% down, appraised value of 300. So now my financing starts at 300. So if my client wants to maintain that 10% equity position, look, sorry, I moved it on you. Look how much more cash they have to bring, because they're paying dollar for dollar of that gap. And it's only because they want to keep that 10% position. The other option we could do is we've got a purchase price at 330, down payment of 5%, appraised value of 300. So now I can lend them 285. That's my P&I, my MI goes up a little bit, but now my cash to close goes down a lot, because I'm simply financing more of the gap than I was here. It's still not the same if they had the true appraised value, but it's definitely better than dollar for dollar. Does that make sense how we kind of maneuver that? And I can't see all you guys, so you'll have to either unmute yourself and ask the question or not, or have me clarify. Okay. So that's a 10%, 5% is an option, 3% is an option if they're a first-time buyer or can get into that income limit. Now here is where we go even deeper. Okay, so let's assume, I'm trying to move you guys out so I can see my screen. So let's assume the purchase price of 330, let's assume appraised value. So total normal loan with 20% down. There's your cash to close. So now let's assume appraised value of 300, down payment. It would still be 20%. I don't know why we have 0, but down payment of 20%. We still keep that 20% equity position. So we're paying dollar for dollar for that gap. Look at that cash increase. A lot. Now, by simply doing a purchase price of 330, 15% down based on the appraised value. Now my loan amount is here, principal and interest. Now in some of these, I would do a one-time fee just because I'm avoiding so much cash. So I could do a one-time mortgage insurance premium of $1,122. And now my cash is a lot less than if they paid dollar for dollar, but still about 10 grand more if I would have had a full appraisal. So let's even go a little bit deeper. Same numbers. So at 330, what if I did 10% down? Now I can do that loan, P&I. Now my one-time mortgage insurance payment goes a little bit higher because again, that one-time mortgage insurance payment is tiered based on the loan to value. But now look at this. Their cash to close is less than if they had a full appraisal. And I'm covering that single pay. And what is the difference in their monthly payment? $1,447 versus $1,415. It's virtually the same loan. I'm just financing a little bit more. Okay. Let's go even deeper. Let's say we purchase that at 330. Let's say the appraised value is 300 and I lend them 285. Now my, one-time fee goes up, but now my cash to close is way less than over here. It's way less than even what they started with. So does that make sense, you guys, on how we can take the exact same numbers of a 330 purchase price down to a 300 appraisal and get that many different options on how to deal with the client, how to show them a lot more cash, less cash, way less cash, barely any movement in your monthly payment. Does that all make sense? So that's why I tell people, like, if you are doing at least, if you're doing 20% down, you should cover full appraisal gap, period. Okay? Because there's no way that our appraisal is going to come in. It could come in this case, literally almost 40 grand low and be just fine. So when you guys write sometimes that 10K appraisal gap, it's confusing to the listing agent, and sometimes it makes you lose when the appraisal gap shouldn't even come into play. So that's what I want you guys to kind of understand or get, because this is the kind of stuff that we can wiggle with, and the client doesn't have to necessarily take that additional cash all out of their pocket. We can maneuver financing to make it work.
Hey, Lisa,
Mhm.
what's a better way for us to put that in contract then instead of giving it an amount? What's a better way to phrase it?
Full appraisal gap coverage.
Okay.
Period, black and white. Now, if you, and again, I do not know your world, with regards to what you guys have to kind of do, but let's say you write it at 20% down and you do full appraisal gap. This is something you should talk to brokers or whoever about, but there are some agents that will write, we will cover full appraisal gap. However, if that means loan to value financing changes, seller and buyer agree. So at the end of the day, what you guys put into the contract really matters when you're doing the offers. But if they've got to cover an appraisal gap and suddenly I'm doing 10% and I perform, nobody cares at that point. But if legally you guys have to protect yourselves or whatnot, that's not my area. So however you guys need to do that, that's what you guys got to ask. Okay, because I don't know that piece of it.
Yeah, that was going to be my follow-up question to that, because there is definitely that presentation of however much you can put down shows you have way more cash, but then again, it might change, what, as you're showing on these examples, which, the listing agent or just us agents might not know, obviously, what's going on with the buyer and their lender on the loan. So
Brad asked a question. This scenario works for those putting 20% down, but not necessarily less. No, Brad, it still does. It's just you would go back then to this screen. So this was a client that was putting 10% down, and we still could do dollar for dollar cash, which means more cash, or we could then do a 5% down, still cover less of the cash required, but they're still bringing a little bit more than the original full appraisal for purchase price. If they're a first time buyer and we can get them for 3%, we can then take it even farther, and then they'll probably be pretty close to the cash that they would need, with then putting 10% down versus 3. So we do still have some wiggle room. It's just not quite as simple. There usually is going to have to be a little bit more cash out of their pocket, but can definitely reduce it. Okay. All right. Any other questions on appraisal gap numbers, how to explain this to a client? And guys, I show you this stuff just to kind of put it in your brain. You do not have to understand or be able to articulate it. That's my job. I can do that. But you got to be comfortable enough to shift them over and go, we need an appraisal gap. You got to talk to Lisa and she's got to tell us how much can we gap. Like if you sent me a client, Brad, and they were doing 10% down and you said, hey, this house is definitely not going to appraise for any more than 300. How much of an appraisal gap should we do? Then I would run this number. I would talk to the client and then I would tell you. Okay. So that you could give the strongest offer that the client was still completely well aware of how much it costs them.
A question I have, Lisa. I did submit an offer with an appraisal gap actually this morning. And my understanding is that, so they were approved up to 500 with 10% down.
Yeah.
My understanding is that those 10% cannot be negotiated at all, so that the appraisal gap can only be covered by extra cash in the bank.
Ah, okay. So this is a really good question. Good question, Miguel. So your person was approved up to 500 with 10% down. So then the appraisal gap, how would that work? Because he offered 500, I'm assuming, or he was at 500. Okay. So then if we're butting right up against that, then I would look at it on a per file basis, because sometimes the taxes are a little bit less. Sometimes the interest rate that we have now versus what we qualified at them is a little bit less. So I could maybe say, okay, I could get to 7% down. So we could cover an appraisal gap for X. Okay. But most of the time, if your clients are butting right up against, it's got to be covered with cash, unless I look at it and say, for this property, we could wiggle this.
Okay. Yeah.
Okay. But yeah, excellent question. Because you're right. If they're right up against it, that appraisal gap sometimes isn't an option for me to go higher on their loan to value.
Okay, thanks.
But, again, it depends, because sometimes if they're at 500 with 10% down, and let's say that appraisal came in at like 480, to do 7% down, I'm probably still pretty close to that similar loan amount. So maybe, or maybe a couple grand more. So I would say if you're that tight, talk to me and we'll tell you.
Good.
Okay. All right. Any other questions on appraisal gap? No, not right now. Okay. I'll open it up afterwards to see. Okay. Cash offers. So cash offers are becoming a big thing in the market. And the reason I brought this up is because sometimes clients come to us, they're like, hey, we want to do cash and then we want to do a mortgage right afterwards. And that cannot always be done. Okay. So here are a couple of rules surrounding cash offers. So if you write a cash offer, client has to be able to perform with cash, meaning they got to have it. So if they are getting a gift, the gift should be deposited or given to them already so that you can literally validate funds if needed. If they are subject to a bridge loan, the bridge loan should be done. So if they're pulling all the equity out of their current property, the departure property, if it is subject to still getting the bridge loan, you are subject to financing. That is not a cash offer. You should do the bridge loan in advance so that it is ready and waiting and available to pull for cash. Okay. If it's not, and you still have to get it, you are now subject to financing, even though the financing is not on your property. But financing does have to happen in order for them to get the cash. So you are subject to financing. The other thing that we get a lot, they want to do a bridge loan, they want to pay cash, but they're short 50 or 100 grand. Okay. So that money's got to be allocated. And we don't love doing mortgages for 50 grand. And in fact, we tell clients most of the time, we're probably going to say we might do them for 70, depending on what it looks like, but usually we want to do them for 100. We have to do mortgages for the long game. And typically if they do a bridge loan and then they want to come back and pay us off in 6 months, I won't do the loan. Because even though the client doesn't have a prepayment penalty, if we pay a mortgage off at 6 months, I get a penalty, I get whacked over the head. So typically I won't do it because it just does, all of our commission comes back, plus they paid us with a penalty, and it actually would cost me money to do that loan. So as much as I love your clients, sometimes I won't do it. So if they are short 20 or 30 grand, you also have to allocate, where's that money coming from? Do they have additional assets they can pull? Can they, get a gift? Can they do whatever to make that purchase whole with cash? So that's the thing, because we get a lot of, well, I'm short 25 grand. Well, I'm not doing a loan for 25 grand. So you got to figure it out, or you're not cash. All right. So now here's the big question. I paid cash and I want to get a mortgage right after. Okay. So here's how it works. This is called delayed, or delay, if we want to call it that, delay financing. So it means the client paid cash, their own cash, no gifts, no gifts. We have to document where the cash came from. So literally, if they had 500,000 in I don't know, like investment account, they transferred the 500 grand to their bank account. Then they brought a 500 grand check to the closing. That's verifying that it's their funds. Okay, we have to see that. We also have to document there's no mortgage on the property. There is no waiting period. We can give the client up to 80% of the purchase price. Okay, so no more than that. And here's the kicker. It is considered a cash out refinance because they're already entitled to the property. So on a cash out refinance, your interest rate is higher than if you paid for a purchase mortgage. Okay, because a refinance is a little bit higher, and getting the cash out also adds to it. So they will pay a higher interest rate for the luxury of doing cash. Okay.
How much
If they want it right away.
How much higher?
Say again, Miguel.
How much higher?
Oh, at 80%, you're probably looking about at least 1/4%, maybe on some days 3/8.
Okay.
Okay. Or they can pay additional fees to buy it down. Again, that goes against what my advice is to clients right now, of paying a bunch of points. All right. So that is if I pay cash, I want my money back. Now, here is I paid cash and I want a mortgage right after. And then you look below, actually, I didn't pay cash, my parents did, and now I have to pay them back. That is a very normal scenario that we get. So here's the kicker on this one that a lot of people do not know. Also considered a cash out refinance, and they have to be entitled for 6 months. We can't even start the process until they have been owner of record for 6 months. You get the hit of the loan being priced as a cash out. And then we can only do the loan for the verified purchase or whatever they gave in gifted money. So for example, if someone buys a $300,000 purchase, they got a gift of $250,000 and then they put in 50 grand of their own money. We could only do a loan for $250,000. Oh, I'm sorry, this should not say no, and I will fix this before I send it. I didn't miss that. Plus closing costs and prepaids. That's it. They cannot get one extra dime back, and all of that $250,000 has to go back to whoever gave them the gift money on the closing disclosure. Okay, not one dime back, not one. It's a like jigsaw puzzle at the end. Max loan to value that we can do is 80% of the purchase price. Okay, so also if I look at this example, 300 grand sale price, maybe the parents gave all 300 grand as a gift. Well, guess what? Now I can only do, hang on, if it's 300, sorry, I need a calculator for everything. Now I can only do a loan for 240. So I can't even get the parents all of their money back. Okay. So keep in mind that stings people sometimes because they want to pay whoever back. They can't do it unless they wait 6 months and pay a premium on the interest rate again. Now, here's kind of a way around it. Parents purchase, they put it in their own name. So they buy a property for the kids, it's in the parents' name. Now the parents can sell it to the kids. So really, there's got to be a purchase contract drawn up. There is no waiting period. It's now considered a non-arm's length transactions, which means you're buying it from family or relative or connected business person. You cannot sell it for 1 penny more than the purchase price. So if it's bought for 300, you can only sell it for 300. And you have to do at least 5% down. You can't do 3% down. If you are doing, or you have to do FHA financing, the exact same thing, parameters apply, minus 2 things. 1, there's a 6-month waiting period. 2, they have to have at least 15% down if they're going to do FHA. Everything here has just been for conventional. So that's the only nuance for FHA. Okay. So if you are going to have family do this, they should buy it, put it in their name, entitle it, and then sell it to their kids. It puts the kids in a better situation financially. They also don't have waiting periods and they'll get a better interest rate. But it is a little bit more legwork because you have to do a contract. Okay. All right. So, questions? Let me look in the chat. Can the kids be on the purchase agreement and title as well? No. Good question, Brad. You're zinging them today. No, they cannot. Just the parents, because if the kids are on the purchase agreement, if the kids go into title with the parents, now you're still back to that refinance, waiting 6 months, paying the additional funds, or excuse me, paying a waiting period and paying the higher interest rate. So no, I wouldn't do it that way.
The contract you mentioned to transfer title from parents to the kid is just a simple purchase agreement?
If the parents purchase it and the parents are entitled and the kids are not, yes, it will take a purchase agreement from the parents to the kids.
Okay.
And there is additional scrutiny because it's now family to family.
Okay.
All right. Other questions on this?
Mhm.
Cash stuff, appraisal gap, costs in general, interest rates. I'll open it up. I'm going to see if I can labor this.
Hey, Lisa,
Yes.
do you, can you speak a little bit more about the waiving it, like waiving the appraisal altogether? You said, you kind of mentioned it in the beginning. I think I might have missed, I don't know if I missed more of it, but like at what point would you, can you offer that and recommend that in the agreement?
So I would say if they have 20% down, I would say full gap coverage, or you can't technically waive the appraisal because we don't know if we're going to get a waiver. So I would just say that you would cover full gap coverage, whatever it is. Okay. Now, this is different than appraisal waiver. So an appraisal waiver will come into play when a client has 20% down or more, and we run it through the automated system and it will come up saying we don't need an appraisal waiver. And so really what that waiver is doing is it's pulling data and saying, if this is our purchase price, is there enough data surrounding this property that we feel comfortable enough that we don't even need an appraisal to inspect the property? There's enough data out there to waive it. That's
Do
what
you
that is
typically,
doing.
do you do that after it's been accepted, or do you ever run it beforehand, something that we can use in our negotiation?
So here's what I would say to that. One, I don't usually run it beforehand, because if we run it beforehand, we now trigger the file. And if we trigger the file, then we have to disclose the loan within 3 days or cancel it and then start completely over. So we would need to do all new stuff on the client, pull new credit, do all that kind of stuff. So it's a pain in the behind for us. But most of the time, these things are also coming up on the weekends. And so I don't know how to run it through our automated system. So that's usually the time where it's gonna be a challenge. Now, if it's during the week and you've like, please, will this work? We'll do it. Just call us. We'll run it through and we'll see if we can get the waiver for you. And then we'll just know we got to really pull all the stops so they get it. Otherwise, it's just, extra work for us and the client, but we'll do it. But it's 20% down or more. Most likely areas, Minneapolis, St. Louis Park, St. Paul, you start to get a little bit more far out. Sometimes there's less data and we won't get it even if it's 80 or 40% down. Okay, but 20% down on a purchase. If I'm doing a refinance, I might get a waiver at 10% down, but that's the limit, 10% down, but purchase 20. Okay, other questions? No? Did this answer kind of what comes up for you guys or clarifies for you with your clients about costs or additional fees or how much will this appraisal gap cover cost me or whatnot? At least it will give you kind of an idea on how we jiggle numbers. Okay. All right. Any other questions? Rates, market? Is there a quiet crew today? No.
One of the first things we're
Just
doing.
absorbing.
Just absorb. I know. I stick a lot of numbers at you, don't it? Yeah. It's a lot, but I think it's so important for you guys just because I know even when I ask people, they get very like, I don't know. And I just want to make sure that you guys at least go, okay, wait, at 20%, I think this isn't going to be an issue. Let's talk to Lisa about it or have her run numbers or, tell us. Like there's sometimes where I could say, you could cover an appraisal gap of 50 grand. And then and that's a massive number. So sometimes that does it. But a lot of times what I think is sometimes these agents on the listing side, they're getting offers and it's hard for them to sift through. So for them to kind of look at, 10 grand appraisal gap, whatever appraisal gap, it's just one more thing for them to try and figure out. So if you can just waive it completely or, it will make it easy. And I know that's not always something that you can do. So I get it.
Can you briefly explain, you mentioned at the beginning, when there are buyer purchases above asking price, it will take them X amount of years to break even with what exactly?
Sure. So let me do this quite on the fly for you. So, okay, fine. Okay, so let me do this. So somebody zip out a zip code to me and I'll look it up for you. And then I'll share my screen. Don't be shy, just say one.
5538. Oh, go ahead.
5548.
55408. Okay, 55408. Sweet. So I am going to share my screen. Not that screen. All right. So can you guys see this?
Yep.
Okay, I'm gonna move you guys a little bit because I can't see it if you're there. Okay, so what I would do is if someone is buying in the zip code, which is Hennepin County, here's the average median home price, half the home sell above, half the home sell below, appreciation over the last 63 years, last 10 years, last 5 years, estimated appreciation for the next year. So let's say he's, what was it listed at, Miguel?
Let's say 500.
Okay, let's say it's listed at 500 and let's just say they've got to offer 550 to get it. Does that sound legit?
Yep.
Cool. All right, so at 500, what I'm going to do is I'm going to say, okay, we think it's listed at 500. We assume that's kind of the fair market value, right? So 500, so if I assume 500 and 5.94% appreciation, that gives me to a purchase price about, or value in a year, about 529,700. Let's assume the next year, maybe it backs off a little bit. Let's just say it goes to, 5% appreciation. That puts me at a home value in 2 years with this estimated appreciation of a home value of 556,000. Now, if you paid 550, I'm basically going to tell you you're biting in to 2 years of appreciation, because in 2 years, you're paying today what your home would appreciate for in this market. So as long as you plan on being here 4 or 5 years, you won't be upside down based on the data that we are seeing. That's how I talk to them about that. Does that make sense?
Totally, yeah. Yeah.
Okay. I use this on every client, and this data is updated the first Monday of every single month. So previously, in what month are we in now? April. So February, March, most of the appreciation levels were low 4s in the, St. Paul or Minneapolis, and then burbs kind of were high 4s, mid 5s. Okay. This, as of April, these appreciation levels have increased. So I don't know if you guys have been seeing that a little bit, but the appreciation levels are increasing. They're not decreasing, which is what we thought would happen in the market if it was going to slow. Housing was not going to correct, but the appreciation levels were going to slow. And month over month, I have seen them increase. So it's kind of interesting. Okay. Okay, but good question. What else? Anything else you guys have questions on? Anything else I can answer? No? All good for today? Okay, awesome. Well, if you guys need anything, please reach out. That's what we're here for. I think there is a lot of fear in this market with clients. I had sweet first-time buyers last night that were like, we're ready to buy. We really thought we were going to wait last year, and we were ready to buy last year, and we were going to wait a year because we thought it would be better, and it's not. And I'm like, no. So again, when I'm talking to clients, I'm showing them, look, if we go into a recession, how many of you guys have been in this business longer than, like, I don't know, 10 years? Show of hands, nobody? Okay. So if you haven't been in this longer than 10 years, what I will tell you is most of you, when I say the recession word, you're going to think of 2008 and think that is the debacle that is going to be ahead of you. It is not. 8 out of 9 of the last recessions, home appreciation levels went like this. Okay. It was only the one, and I can't even say the last one because I bet you guys didn't even know this. We had a recession, a 2-month recession in 2020. Nobody even knew it, right? It's the shortest recession on record. But in 2008, because we caused it, housing went in the toilet. It was our fault. We gave people loans that didn't even have jobs. Like, it's gonna happen. But this recession that is probably looming in the next 12 to 24 months will simply be because the Fed's gonna have to increase interest rates a bunch. And there's no way that it's going to be what they call a soft landing, which means that inflation will go smoothly and everything will work. Usually it's going to go, and then they're going to have to stimulate the economy again, which means recession, which means lower interest rates. So that's what I tell a lot of clients right now is if you can get in now and deal with the rates that are there, it is very likely better days ahead. Because if we go into a recession, interest rates will come down. We could refinance you. We're probably going to look, if we look at past recessions, the interest rates have come down anywhere from 1 point to 3 points. So if we can get back into those, low 4s or high 3s, that's refinance time where you can lower your monthly payment. But the value of your home is done like this. So now that equity position looks even better, if that makes sense. Okay. So that's the thing that we're talking to clients a lot about now because they don't, the recession period is only, the last one where the housing was really the problem. Most recessions, housing does well. All right. Anything else? Otherwise, we can wrap up. I will send this PDF to you so that you guys have it just as reference. But most important thing, cash sometimes is not always the best option to your clients if they want a mortgage after, and how to make it the best option. And then 2, this appraisal gap stuff is just lots of numbers, but have them talk to us because that's what we want to do and make sure we get them the property. Okay?
Okay.
All right.
Thanks, Lisa.
Thank you,
You
Lisa.
guys have a good rest of the week. If there's anyone that needs our help, please let us know. We're taking all new clients, anyone you got. Talk to you guys soon. Bye.
Thank you.
Thank you.